Hi, thanks for joining me again. Just doing a quick video on accumulation and re-accumulation. They are very similar, it's just the circumstances that the market is in at the time as to whether it's an initial accumulation of a stock or a re-accumulation after some form of selling has happened in the background. I'll look at some real world examples of accumulation. I'll also look at the most orthodox style of accumulation. Generally, the most orthodox type of accumulation is seen with climactic action at the bottom on very high volume. Price then moves sideways while supply is mocked up. It goes up and down, teasing investors or holders before it breaks out. Will often come back and test the breakout for strength before accelerating away. Now in the real world, the price action isn't always as clean or clear cut as this shows. This is the most orthodox style of accumulation. If you can understand this and the shape of an accumulation zone where price pushes down, breaks below the previous lows, it then moves sideways and then pushes out. That's the shape of an accumulation. They're not always that shape. In the real world you'll see different things happen, and I'll show you some examples of that shortly, but that's the most orthodox and normal shape of an accumulation. Down, climactic action of some sort, sideways to finish the accumulation and mop up supply, and then a breakout of the zone. Now this is DTL. There's a very orthodox accumulation style here. You can see prices broken down, it's in a downtrend. In the background is some selling, some supply. It may not be overwhelming supply, but there was selling in the background. The prices come back, and most likely this period here is some form of reaccumulation, because when there is selling in a stock, it doesn't mean that's the end of the stock. It just means that somebody's sold their position down, the stock needs to recover. Those same sellers may then buy back in. They needed to take some profits for whatever reason at the time. So you can see here price is broken down. I'll mark the high of the breakdown, because when price gets back above a breakdown bar like that, you can take that price may be becoming bullish again. It's in a position to become bullish again. Now you can look down here that quite strong volume came in as price broke down, and the next bar was up in response on still quite good volume. That's your initial telltale sign that there was buying in this bar. The mid bar close is also a helpful hint. Now look at this even higher volume, and look at the narrow spread on this down bar. It's a down bar, it's closed lower than the previous close, and the spread is very narrow and the volume is very high. Now you need to consider how that could possibly happen. What circumstances could happen in the market for the spread to be very narrow on a down bar, but volume to be higher than the previous two down bars or the previous two bars? You have to consider how that can possibly happen. And the only way it really can happen is if buyers have stepped up and they're absorbing, buying whatever supply is in the market, keeping the spread narrow. You can see the close is back in the top half of the bar, and then the next bar is up in response, albeit on very low volume, which is telling you that anyone who is going to sell sold out on this bar, and then the market's floated up on a lack of supply, and the buyers kept on buying in the next bar, and you've got a really strong response where price is then consolidated. It's moved sideways. It was even too strong to move down and consolidate. It's moved sideways and consolidated, pushed up to the highs of the breakdown bar, and it's come back and it's retesting the lows. And you can see straight away that buying is likely to come in again, confirmed by the next bar being up, the next 3 bars being up, and then prices move back up to the line again where we consider price could turn bullish again. Now at this point supply has become very low at the most part, and you can see some more supply came in here. In response, the market's pulled back, sort of like a shakeout really. It's tested the high of this bar where we saw more buying come in. This is a bit like a double bottom. This is the response. There's been a little bit of supply to mop up. Prices pulled right back, and then it's accelerated out here on this bar. Once again, normally you'll see some sort of consolidation in a form of bull flag, like this. However, in this case, the market was so strong, it couldn't even pull back properly. Whenever a consolidation is in the top half of a breakout bar or the top half of an uptrend, where you get an uptrend like this, whenever these consolidations are less than half of the actual acceleration higher, you can consider the market bullish. So the market's moved from there to there, and prices come back half or less. Same again, half or less. And in response to all of that, you can see prices considerably higher in response. Just go back and have a quick look again. This is your classic type of accumulation where price pushes down, it breaks down, it then moves sideways and then pushes out, and that's the classic shape. Now in this case, because all stocks in the real world have their own bit of personality, prices had to go sideways. It's come back a second time to flush out or mop up any further supply before price is actually broken out. But this shape here, this down, across and up, is your classic accumulation or reaccumulation in this case shape. Okay, now let's look at one that's different. This is A2 milk. You can see prices been travelling sideways. It's also in reaccumulation mode after some form of selling here. Now here in this stock, you can see right there, prices dip right down, volume's very high, and this is different because generally you would expect price to come back down and retest the lows, but it's too strong. You can see we draw a line across the high where I did before, and it's really only accelerated out straight away. It's come back, tested the breakout, and then it's pushed higher. It's done a little bit of testing here, but the stock is too strong. What's really happened, I'd say, there was buying obviously in this bar here, and the only way the market could accumulate or reaccumulate was to move into absorption mode. And this is like some form of bullish absorption or absorption where prices worked its way up and down before it moves out, and then whenever price breaks out or gains considerable ground, you'll find supply is inevitably drawn out, and when that happens there's a consolidation. A consolidation is the market absorbing that supply that's been drawn out when there's been a substantial gain in price or a breakout. In this case it was a breakout or an acceleration higher, and then the market's immediately moved into absorption mode and gone through absorbed supply, and then the market's pushed higher. And it goes through these patterns all the time, or push higher, consolidation, push higher, consolidation, and this is how the market moves. So this is a different shape altogether. You can remember this shape. This was some form of climactic action here, and there was your normal push above the high of the breakdown bar to establish prices bullish, but instead prices moved into an absorption pattern, because that was the only way though that the market could accumulate this stock. The underlying strength was too strong. Okay. Now a little micro cap. This is a lithium miner, back before the lithium boom, and price was in a downtrend. It came down to 1 cent. You can see a little bit of buying came in just here, but I'm not sure that was really the accumulation. That might well have been the retail market. Here is different. This is more likely some form of speculative professionals buying into the market. You can see there was no climactic action. The only way that stock could be accumulate was to buy the offer. So they buy the offer and then let it fall down, close mid-bar, buy the offer again, let it fall down. Once they remove their support or their buying, the market just drifts lower under its own weight. You can see price came back. Look down here, you can see volume just got lower and lower across this period here. At that time, the offer gets reloaded, and then all of a sudden, boom, they come in, buy the whole lot up to a certain level, and then release the brakes and don't support the market, because they don't want to buy against themselves or push the market up against themselves. They let the market then drift lower again in response. It moves sideways until the actual breakout happens. And if you draw a line across there, where they let the market drift, it's drifted down. There was a couple of little volume bars come in, but almost nothing left. Those who are going to sell have sold, and price accelerates out. And accelerates out with a bit of vengeance there. You can see the response. Price is up 25 cents from 1 cent. So that's another shape you can see where there was no climactic action. The only way to accumulate a position was to buy the offer. It was all done with buy the offer. Here, here, here. These are your volumes here, here, here. So if we look again, you've got a more traditional climactic action, double bottom shape, and then this has happened either waiting for favourable trading conditions to happen before the breakout, or mopping up further supply. This is your shape here of a traditional or more orthodox accumulation zone. And the A2 milk one, there was a climactic bar here of some sort. We might call that one stopping volume because it's not massive. But then there's been a bullish absorption or absorption zone. That was, the stock was too strong to come back and test the previous lows, and that was the way the market accumulated there, or re-accumulated there. And a micro cap, where all the buying was done as a buy the offer style. There was no climactic bar whatsoever. So remember those shapes, because they're commonly seen in the market, and there are different ways the market can accumulate a position. And when you've got accumulation or strength in the background, you'll often see where a market will trend higher for a period before those professional speculators can then move their positions on and take some profits. Okay, thanks for that. See ya.